Hello there, everybody, and thank you all for joining us for our Q1 2026 quarterly market review. My name is Russell Munn, and I am one of the financial advisors here at Hermitage Wealth Management. As always, with these quarterly market reviews, we like to bring on a trusted partner to provide us an update on a host of different economic topics. And I will say I'm very, very excited about the guests that we do have today. Today, we have Elizabeth Dooley that will be joining us from City National Rockdale or RBC. And a little bit about Elizabeth. She's been in the finance industry for 30 plus years and 20 plus years with RBC Rockdale as well. A little bit more about Elizabeth. She earned her BBS in finance from Dublin City University in her native Ireland. She holds the Chartered Financial Analyst designation and is a member of the CFA Institute. She also holds the Chartered Alternative Investment Analyst and Certified Private Wealth Advisor designations. She's also a member of the New York Society of Security Analysts and is an active member of her community. And when she's not doing all of that stuff, she likes to spend her free time volunteering with various organizations. And another thing I will say that didn't make it in her bio, but she's actually a personal favorite of mine when it comes to the webinars that City National Rockdale will put out that we actually attend and such. So, Elizabeth, very, very happy to have you, and thank you for joining us today.
Thank you, Russell. It's a pleasure to be here.
Absolutely. Well, very, very good. Now, I know we have a lot to cover today, and as I said, I was very excited that you were going to be our presenter for today. And of course, some of the topics that are top of mind, and in meetings and reviews that we have with clients, of course, is what's going on in the world, right? I mean, it's obviously been an eventful 2026 to say the least. So, very excited to see what you have to show us today, and I'll let you jump right on in.
Thank you. So what I thought I would do, everybody, is start with our speedometers, our economic and financial indicators. Now, just to note, these are as of the end of February, so it's before all of the issues in the Middle East have evolved over the last couple of weeks. And you'll note here on the bottom right-hand side, we actually had our geopolitical risk dial moved into the yellow. No surprise to hear that we'll be moving back into the red. But really what I wanted to do is spend a little bit of time on how we came into the year and how we see things currently. So coming into the year and coming off of a very strong 2025, there was an expectation for 2026 to be a similar year. And we were looking for GDP to increase slightly, GDP growth to increase slightly, driven primarily by productivity gains. And we were also looking for corporate profit growth to continue at a similar pace to what we saw last year. Now, with everything going on in the Middle East, the big question is what's it going to mean not only for the US economy, but the global economy going forward. And if you look back, and we look back at previous energy shocks, I think it was 4 out of the 5 times, it ended up pushing the global economy into recession. Now, we're not necessarily seeing the same situation this time around, but what we have to bear in mind is that whenever you have a supply shock, the question is always magnitude and duration. And anybody who's filled up their car over the last week or so has seen gasoline prices go from, on average, I think it's about $2.80 to about $3.60 a gallon, right? So we've seen an increase in gasoline prices. We're also seeing diesel prices moving up. If we look at U.S. crude oil, we're up to just shy of $100 a barrel. Looking at the consensus estimates from various economists, we would have to be closer to $140 a barrel, and for it to stay there for an extended period of time, for really us to be concerned about this pushing the US into recession. And what you also have to remember is the disruption in supply is really having a much bigger impact, say, on the Eurozone and other parts of the world that source a lot of their oil and natural gas from the Middle East. We're not seeing any disruption to U.S. supply. And if anything, we see U.S. Activity continuing to increase, because when oil is at a higher value and it's expected to stay there for an extended period of time, the producers are more willing to increase supply, right? So we're not concerned about any kind of supply disruption or availability concerns for the U.S. But the other piece that we have to bear in mind, when we talk about what's happening with the Middle East, is that it's not just oil and natural gas, but it's a lot of the chemicals and minerals that are used in other parts of the economy. So, for example, sulfur is a byproduct of natural gas production. Sulfur dioxide is used in a lot of different chemical processes. So that's a part of the supply chain where it does impact the U.S. If you look at the material stocks and how that sector has performed over the last couple of weeks, it went from being one of the best performing sectors to one of the weakest, because there is the potential for disruption leading to higher prices. It's almost like, best case, companies will take a hit to their profit margin. Worst case, companies are passing on the higher cost. That would be a negative for consumption. So as we look at what's happening in the Middle East, it's not just oil and gas, but it's really a question of how long it continues and how meaningful the supply disruption actually is. What's making us a little bit more cautious, I will say, over the last couple of days, is that as you see more damage to infrastructure, then the likelihood of the supply disruption lasting longer and having a more meaningful impact becomes more of a concern. And that is definitely something that we're paying attention to. But again, it comes back to, we're not necessarily seeing supply disruption directly impacting the US, but we're impacted because of global pricing and global supply. When we come back to how the US economy is doing overall, US households overall remain in a pretty good financial position, right? The higher income households, which are typically the households that drive consumption and drive discretionary spending, they're still benefiting from strong equity markets over the last couple of years, and also the increase in real estate values. Household indebtedness, while it has gone up, it's really the lower income households that are feeling more of the squeeze. The higher income households, they still have significant credit available. So in terms of households' ability to spend and invest, that remains positive. But when there's a lot of uncertainty, like there is currently, don't be surprised if the next quarter or two consumer spending is a little bit weaker, because everybody's a little bit more cautious in the short term. We don't necessarily see that as something having a longer term impact. Also, when we look at the labor market, yes, over the last couple of months, you've seen more layoffs announced. But again, I think it's important to keep it in perspective. We had significant hiring during COVID, and we really have not seen any meaningful layoffs since. It is pretty typical every 4 to 5 years that companies look at their labor force needs, and to a certain extent they try to right size. So to a certain extent, it's those regular layoffs that we're going through. Also, when you hear companies announcing layoffs, they tend to happen in clusters, because no one company wants to be the headline of that they're laying off. So again, not a huge surprise that a lot of these are bunched together. We do think that the blaming of AI for the layoffs is a little bit oversold. Yes, definitely some of this has to do with companies making significant technology investments and expecting to see productivity gains from them over the coming years. But blaming AI for the layoffs, we don't think that really tells the whole story. As we think about the labor market going forward, we are seeing that companies are a little bit more cautious. They're not necessarily firing, but they're also not necessarily hiring. So for somebody who has lost their job, it is taking a little bit longer to find a job. But even having said that, when we look at the unemployment rate, we remain close to historical lows. The vast majority of people are working and collecting a paycheck. And as long as they're reasonably confident that that will continue, that's really what drives consumer spending going forward. When we look at the business outlook and business spending, the business outlook and business spending took a hit last year when there was all of the uncertainty around tariffs. We'd seen that improve, towards the end of last year, as it looked like the tariff hit wasn't going to be quite as meaningful. Again, as we look at some of the survey results over the last couple of weeks, it is hinting to businesses being just a little bit more cautious in the short term, which again is not a huge surprise when there's a lot of uncertainty globally. But our expectation, particularly if events in the Middle East continue and they don't have as much of an impact on the US economy, short-term interest rates have come down. Tariff impact is expected to be not as onerous as everybody had thought it would be. That's typically a slightly better environment for mid and small cap companies. So our expectation would be that mid and small cap businesses could actually be a little bit more of the driver going forward. Our US large cap companies, which for the most part tend to be more multinationals, we really have to look and see where the earnings are coming from, and if we expect any change or any weakness in their outlook going forward. Because part of our premise also coming into 2026 was that we were expecting to see stronger growth in other developed markets. We still expect that to be the case, but again, the reality is the Eurozone is more directly impacted by higher oil and gas prices and the disruption in the Middle East. So that is something that we may end up adjusting, and it is something that we're paying attention to. When we look at the housing markets, particularly in the US, things have been picking up. We have seen longer term interest rates move up over the last couple of weeks. I think we're up to about 4.25% on the 10-year. Mortgage rates are driven by 10-year Treasury yields, so we've seen mortgage rates come back up. So if you see a little bit of weakness in housing again in the short term, that's not a huge surprise because mortgage rates have backed up. But our expectation would be, as we get through this uncertainty, and provided there's not a significant inflation impact, because that's really what longer term rates are pricing in, we would expect housing to pick up again and be a driver of economic activity going forward. And then, as I mentioned, with energy costs, we see this more of as a short-term impact that we're dealing with. And look, the reality is nobody likes to pay higher prices at the pump, but we are almost past the winter heating season. We haven't yet started the summer driving season, so we have we're at the time in the year where demand for energy tends to be a little bit softer. So we do think we'll be able to weather through this, and as we get through the next couple of months, we should have better certainty in terms of the outlook and what we're expecting to see going forward. In terms of our forecast for the year, we are still expecting productivity gains to be a driver of GDP growth. But the one thing that we have to bear in mind really is any prolonged impact on demand, right? So if supply shock continues for an extended period of time and prices are higher, that typically results in lower demand. Now, there's been some conversation the last couple of days around the likelihood of the Fed cutting interest rates and the possibility of the Fed raising rates. We had come into the year expecting 1 to 2 rate cuts. We're still expecting at least one, but probably not until later in the year, until we have more certainty. There has been some talk about the Fed having to raise interest rates. We don't really see that as being on the cards, because if you think back, over the last couple of years, during COVID, yes, we had higher energy prices, which ultimately led to higher transportation costs and ended up being deflationary. But demand remained strong because the government was putting money into the economy and was making payments to households to support demand. We don't see a repeat of that, right? So if we ended up in a situation where the supply shock is prolonged, leading to lower demand, if we have lower demand, less likely that we see significantly higher inflation, and it's also less likely that the Fed is raising rates. So it is more likely that the Fed stays on the sidelines and continues to monitor activity, right? Because again, the expectation coming into the year was that inflation pressure would remain a little bit higher as demand remains strong. And then, as I said, with interest rates, looking at the 10-year Treasury, we're up somewhere between 4.25% and I think 4.3%. We're somewhere in that range today. We do think once we get through this period of uncertainty, those rates should come back down, and we're targeting somewhere around the 4% rate for the year. Also, as we look outside of the U.S., so our view coming into this year, and part of this has to do with a lot of the policy decisions that were made last year and a lot of the uncertainty that we had around tariffs. For those of you who've been RBC Rockdale clients for a number of years, you'll know that we've had very little investment in other developed markets for the last 5, 6 years. And the reason being that we felt while valuations outside of the US, particularly in the Eurozone, valuations were attractive, the growth story just wasn't there. But partly due to all of the uncertainty last year around tariffs, essentially what it ended up doing was forcing a lot of our trading partners to reevaluate their trading relationship with the US and their reliance on US exports to drive growth. And they were moving towards more of a focus on investing in their own economies and focusing on domestic consumption. And the expectation coming into this year was that focus would be a driver of stronger growth, particularly in the Eurozone. Towards the end of last year, we started to take some of our gain in US equities, and we started to add to other developed markets. If you look over the last couple of weeks, the Eurozone is down more than the US, and that's reflecting a lot of the uncertainty around growth going forward. Again, our view is we still see this as a buying opportunity. Now, again, that could change, but we still see it as a buying opportunity. If the supply disruption is short-lived and the economic impact is contained, we're still positive on our outlook for the Eurozone going forward, and we still think it's appropriate to have some investments outside of the US. And then the other thing to touch on is really around equity markets and volatility. We've, again, given everything that's been happening over the last couple of weeks, the volatility that we've seen in the market has been pretty contained, particularly if you compare it to where we were this time last year. But again, when you go through these periods of uncertainty, we would expect to see more volatility in equity markets. I think it's fair to say investors are really trying to sort through all of this, right, and how long they think the impact will be. I would not be surprised over the next couple of weeks if we see a little bit more volatility in equity markets. But if I think about how we're positioned, our U.S. equity exposure is primarily in the large blue chip companies. Those are companies with strong balance sheets, with predictable cash flow. And we do think that we're in a position to be able to weather through any of the uncertainty that we have. Russ, if it's okay with you, I was going to pass it back to you to see if there were any questions.
Yeah, no, well, first things first, Elizabeth, thank you for all that information. I mean, one of my favorite things, and throughout your presentation, I will say, is you started with the speedometers, and many clients that will be on this presentation. Funny enough, that's one of the first things we pull up when we're going through our kind of market commentary and review and such. So, again, it's funny, right? You started there, and again, I think it makes sense because it's such a great way to look at so much information and make it pretty easily digestible. But the second thing that again I really enjoy about your presentations, right, is with all the news and headlines and ability to obtain information from so many different sources, right? Again, I think y'all do such a great job of kind of cutting through that, making it simple as possible, right? And again, I really do appreciate that. Now you're right. We actually did have a couple of questions that kind of came through here, and I just wrote them down, so I'm going to kind of look down at my paper here. But you mentioned it a little bit in your presentation, but I think the overarching consensus is a little bit of uncertainty, a little bit of volatility, and that risk as a total is probably going to be a little bit more relevant. Now, speaking of risk, one thing that we've talked a lot about in previous years with clients is this run up in big tech, right? The fact that markets are, overvalued, right? I mean, that speedometer, right? If we go back to that, again, that has a negative connotation for equity market valuations into the future. So, again, the stocks are expensive, right? That's what that means. So, again, with all this volatility and changes and uncertainty, I mean, do you think that this thought process of an AI bubble or tech or, anything along those lines has some legs to run forward, or what are our what are RBC's thoughts on the tech market, I would say?
So yes, we would agree in terms of particularly kind of middle of last year. The valuations for the Mag 7 were, I think we were at over 40 times forward earnings at one point. As of the end of February, we've come down to about 26 times forward earnings. Now that's a combination of the earnings outlook increasing, right? So the E in the PE in our PE multiplier has gone up, but also we've seen some softness in basically tech and communication services. Started end of last year and really continued into 2026. The software sector is an area that's been in the headlines. We do think there a little bit of that pullback and the concern about AI taking over a lot of those businesses and having a meaningful impact on revenue going forward is a little bit overblown. But yes, we do expect it's going to have some impact. I think probably another way of looking at the AI story is that maybe the easy money has been made over the last couple of years. And as we look forward, it really is going to be more of a focus on, okay, these companies are making significant capital investments. We still think it's very much in the early stages, but investors are going to start to want to see results, right? So there's going to be more of a focus on where the revenue is coming from, and probably a little bit too more of a kind of sorting out of the winners and losers. But we still think in terms of, and I think we have it here on one of the slides where we talk about kind of where we are in terms of AI adoption and what that means going forward. I think the statistic we have here is that approximately 20% of US businesses have adopted AI. And when you think about where's the real opportunity in AI, it's that last level. It's all of the sectors outside of technology and communication services. It's everybody else starting to adapt and use AI. That's really where the opportunity is. And that's why I think as we look at kind of where valuations are and where investor dollars are going, you're seeing a little bit more going into other parts of the market and reflecting that that we see more of an opportunity there going forward. But no, we absolutely do not think the AI story is over. It's very much in the early innings.
Right. Well, very good. No, I appreciate that, right? I mean, one of our mantras here at Hermitage, right, is that diversification does work, right? And I know that's been a harder, concept, right? Especially, like I said, with a lot of run up in big tech, right? But I think last year was a good recipe for that, right? Where again, some of these other asset classes that you can invest in, right, really did provide some benefits, right, from an investment perspective. Now, another question that did come in, and I know you kind of talked on it a little bit, and may not have to elaborate too much on this, but of course we'd be remiss, right, to talk a little bit more about the U.S.-Iran, conflict, right, and of course the effect it has on geopolitical events, and primarily, right, you talked about oil and gas, right. I mean, I filled up my gas tank today, right, and it was $3.79 per gallon. So again, even here in Richmond, Virginia, right. I mean, again, we're definitely feeling that rise, right? And of course, one of the biggest probably concerns, I would say, you talked about it, right? Consumer spending, the effect on inflation, and overall, right, the effect that it has on the Fed, right? I mean, going into this year, right, we had these expectations of what it would look like, right? So, again, as the thought process that this is just very much a short-term effect and trend, obviously with oil prices and spending potentially, or is there a chance that it lasts a little bit further, right? And then we're kind of talking about a new Fed chair coming in. Again, I know it's hard to predict, right? But I guess in the grander scheme of things, right, with all this volatility and uncertainty, I mean, what are conscious things that we can do as investors or as advisors, right, to kind of position portfolios for clients moving forward?
Well, I think probably the biggest thing is not to overreact to the short term, right? And just like we said this time last year when we were going through all of the uncertainty around trade policy and tariffs, our view, and I'm going to say it's the same this time around, is that we want more certainty in the outcomes before we're going to make significant changes to portfolios and how we're positioned. And when you think about inflation and the Fed, what the Fed is concerned about is the inflation that gets embedded in the economy for the long term. It's not the short-term supply shock, right? Because if gas prices are high for a short period of time, relatively short period of time, consumers don't like it, but they typically don't make major adjustments to their spending. Whereas if they last a long period of time and consumers expect them to continue, then they start adjusting and they start making changes to their budgets and how they're spending and how they think about spending and investment going forward. And that's why, as I said at the very beginning, when we have a supply shock, it's always magnitude and duration. That's what we have to look at, right? Is this a fundamental global change, or is it a short-term move that we have to deal with? And then what are the longer term consequences? And then what you also have to keep in mind is that sometimes you can have something that's it feels like it's a short-term event, but it can have some impact on prices and inflation a couple of years later. So one example that Paul Singal, our economist, use, it's basically the price of beef and chicken and kind of why have prices gone up? A lot of it has to do with a drought that happened in Texas a couple of years ago. The farmers, sold off the animals earlier, which means they weren't in the supply chain now like they should be. So you've got an event that happened a couple of years ago, but it's really only showing up today. So that's what we're always looking at when it comes to the inflation numbers. What's driving it? And do we expect it to persist? And if we do, what do we expect the impact on interest rates to be? And that's why, sometimes the Fed gets accused of being too slow with their decision making. But if you think about it, they want to be more certain of the outcomes and what the data is actually telling them before they're going to make a move, whether it's cutting interest rates or raising interest rates. And that's why I said, coming into the year, our expectation was that we'd see 1 to 2 more rate cuts. Now we've had some uncertainty around, where the economy is going and what the impact on inflation will be. So don't be surprised if the Fed is on hold for at least the next couple of meetings. And then when we have more certainty around the impact, then it'll be a decision around, whether they're cutting interest rates or not.
Okay. Well, very, very good. I appreciate that. And then the second part of that question, again, I kind of threw them together there. With some of this uncertainty, right? Again, what are changes that could be proactive, right? And again, we don't want to necessarily be reactive investors, but what are changes or things that you're seeing from a portfolio perspective or an asset class perspective that could be a little bit, at least a little bit of a safer bet, at least as we're going through this short-term volatility.
Well, even within our existing portfolios, and this started in the fourth quarter, we had been trimming some of our U.S. equity exposure, so our large cap winners, adding to some more defensive sectors within large cap, right? So areas outside of tech and communication services. And then also, as I said, looking at investments in other developed markets. That's something that we're continuing to do selectively as we see those opportunities. And I think the biggest piece of it is, and we've all seen the slides, right? Which is if you miss the best days in the market, right, you miss the returns. So again, I would come back to that for the most part, we're in quality, right? We're in large blue chip names. We're in, for the most part, high quality bonds. We're not taking excess risk in portfolios. So we're in a position where, we're able to kind of stay where we are and to a certain extent, wait and see how this plays out. For clients who have much riskier portfolios, you may want to dial back the risk a little bit. Because, typically that's what investors leave. They leave risky assets when there's any concern. But we're not there, right? We're in quality to begin with. So I think we're in a good position.
Okay. Well, very, very good. Well, again, Elizabeth, I appreciate one, obviously you coming in and giving this presentation to our clients and the overall support that we get from RBC Rockdale as a total. Now, in closing, for everybody, again, I hope everyone enjoyed the information. And of course, if anybody has any questions, concerns, if something came up, obviously, as you were listening through this quarterly market review, please feel free to pick up the phone, send us an email, especially when these events are happening, and especially at a rapid pace is what they tend to unfold. We're here, right, to make sure that we're here to support you and answer any questions that you may have in the long term. But again, Elizabeth, I thank you very much for your time, and I hope everyone has a good rest of the day.